this is a very unusual recession, if indeed we are in a recession, because you've got so much capital still on the sidelines, over $4 trillion cash. So worldwide. And so, this is not your grandfather's recession. Plus you have full employment right now. And the Fed, the big debate is what is the terminal velocity of that interest rate? Is it going to be 5? Is it going to be 5.1, 5.2, 5.3%? We just don't know yet. Rates are down today after the latest data. So, there's a disconnect between the Fed pounding the table saying we're going to keep raising rates and what long-term bonds are doing. They don't believe them. And so, it's a very unusual situation. The Fed can keep making noise, but it's not working yet. And certainly it's a tight labor market.
Welcome back to Market Empire. We are again having Kevin O'Leary of a Shark Tank, who has taken much flack for the FTX fiasco and the rumors that followed, once again in the spotlight of the financial markets. In addition, he has a brand new television show called Money Court. In this video, Kevin discusses how a rise in interest rates has impacted his capital strategy choices, his thoughts on the recent decline in inflation, the disconnect in the bond market, and more. Other topics he covers include the development of cryptocurrency regulation and the potential of digital payment systems. Check back with Market Empire soon to learn his predictions for the future of the economy and whether or not a decentralized currency is in our near future. At the outset, Kevin talks about the current inflation rate and how it is far above the Fed's target of 2%. The drop in inflation to 6.5% from 9.1% is significant. He further argues that the CPI may be understating real inflation because housing data has rolled over and is no longer accurately reflecting market conditions. Kevin says that he prefers equities over fixed income and debt, so his portfolio is weighted toward equities by a ratio of 30-70. Even though most businesses are making cuts, he says, they're doing a pretty good job considering how much more efficient they've become thanks to technological advancements over the past 3 years. Earnings revisions are in the future's cards, and he's looking for companies that generate cash flow and share those profits with shareholders. He also likes gold and thinks the healthcare and commodities industries are promising. To hedge against the high cost of digital payment systems, he is not over-investing in energy while under-investing in technology stocks, which are currently trading at over 20 times earnings. According to Kevin, there is a battle for control over regulations, but some oversight is inevitable. Now we'll get into the meat of Kevin's investment video and hear about his thoughts and advice.
Now, one thing about that data, that CPI data, and lots of other analysts are talking about this, the housing data has rolled over in there and it's not reflected properly in this CPI 6.5. The real CPI, if we actually were to take true pricing of housing in major markets in the US, whether that be semi-detached, rental units included, standalone homes, certainly office and industrial space, that has rolled over, and it is representing a too high an inflation rate inside the CPI because the data they use is 11 to 18 months old. So that's why you're seeing this disconnect in the bond market. Anybody that buys bonds, a fixed income balance sheet investor like me, knows exactly why these spreads have tightened, particularly on triple B credits. They don't believe that inflation is actually 6.5%. Inflation may be as low as 5% right now if we were to true up the data from the housing market.
Do macro conditions, including rising interest rates, let's focus on interest rates first. Interest rates have been rising. Has that affected your capital structure decisions? How much debt and equity in proportion to each other you keep on your balance sheets?
That's a great question. I've still kept the ratio of 30% fixed income and debt to 70% equity because I find equity is still more attractive. The way I look at equity now for the balance of this year, anybody that forecasts past a year, I mean, I don't know how you can do that, but right now I'm assuming the Fed is going to slow down a little bit and probably not pass the 5% terminal rate. And while they wait and see what happens to the economy. So most companies are starting to really cut costs any way they can. But there's been so much productivity with technology over the last 3 years that they've been doing a very good job of that. So you're going to see some earning revisions at some point. I don't anticipate any expansion to PE because we're still sitting at a 17 PE. So I don't think that's going to go up. So I'm looking for companies that A, are cash flow positive, B, do distributions of profits. So in other words, they take the cash and they distribute it through dividends. Some of them will do share buybacks, but not now that's being taxed. I think the dividend is going to be more popular. And so you have to be doing that without taking on debt. So if you have a clean balance sheet, not too much debt, and you're distributing profits, well, that's a good place to invest, because you can probably make 5%, maybe 6% on capital appreciation in the next year, and maybe 1.5 to 2% in dividend yield. So I look at healthcare sector, very interesting. I like commodities. I like gold right now. I've pulled my horns in a little bit on tech, because those are still trading at over 20 PEs, which is expensive, and those stocks have already had massive corrections. Media stocks are really interesting. They're fibrillating right now because of all the streaming losses, but you've seen some recovery in those names over the last 90 days as people start to say, well, who's going to survive the streaming wars and who isn't? Because media itself is an interesting business model if you think that you can get direct to consumer. Disney is under scrutiny now. I own that name. Nelson Phelps has said he wants to be an activist. That's probably good for the stock. And so you've got to find these situations. So underweighting tech, not overweighting energy. I think energy's had a fantastic run, but I think you want to take a little bit off the table there. It's been a very, very good place to be last year. I don't think you'll get the same kind of returns this year. Finding those large cap names in the S&P that have strong balance sheets across multi-sectors that pay distributions, that's the play for 2023.
Kevin also discusses the future of money and the trend of the separation of money and state. He explains that this will not occur because as long as you have a completely uncontrolled, decentralized version of money, people will take advantage of you. He thinks that significantly higher standards of transparency and accountability are required. When asked how he would hedge against inflation if the Fed does not reach its inflation target of 2%, Kevin stated that he has been lucky over the previous decade to spread 6% of liquid assets across a fairly diverse portfolio, which has not been simple but is an honest effort. Kevin O'Leary stated that he has a 5% investment in Bitcoin, which has performed fairly well despite the scandals and other events.
I have a 5% weighting in Bitcoin. That's actually been performing quite well, even with all of these scandals and everything else. I've got a large allocation to equities. No equity more than 5%, no sector more than 20%. So it's very diversified. And I have a lot of cash on hand right now because of some sales I made last year before some of the taxes went into effect on share buybacks. So I'm actually shopping to put more money to work, and I'm doing it. Looking at private equity, all kinds of new alternatives are emerging. And so the whole idea is my job is to get up every morning and put capital to work and find the path of least resistance. My bogey is to make 6% a year. Doesn't sound like a lot, but it's not easy. And so when you think of a broad portfolio, to distribute 6% cash, that's not easy to do. But I've been very fortunate in the last decade or more, and I've been able to do that.
Overall, anyone interested in the economy and the future of finance will find this interview insightful. In the section below, please share your thoughts and ideas on Kevin O'Leary's macroeconomic outlook. Remember to click the like button, share this video with your friends, subscribe to the channel, and click the bell to be notified when new Market Empire videos are uploaded.